Okay, good evening, and we are here today in order to touch base upon a couple of topics in APM which find their base in financial management subject of skill level, something that has been discussed in AFM exam as well. Now, please understand that the objective of including these topics in your APM exam is different as compared to what was the case in AFM. In AFM, the paper relied upon your ability to distinguish between you know different methods of investment appraisal, understanding or giving some sort of a conclusion on which method of investment appraisal is better and what does it help you to achieve, then giving your verdict on whether a project should be accepted or not. And of course, there were multiple adjustments, foreign exchange, and all of that was involved in AFM. In APM, the emphasis is slightly different. So let's quickly revise these concepts so that if they come up in the APM exam, you know how to deal with it. I promise we'll not spend too much time on these issues, but yes, when it comes to attempting these questions in the exam, we should know how exactly are the calculations to be done. Now, when it comes to see what is the name of our exam, the name of our exam is Advanced Performance Management, which means all questions that we do or all topics that we touch upon have to be understood from a point of view that if you want to evaluate multiple projects across different time horizons or across different countries, do you have the right tools for measuring performance? Like, say, for example, I want to evaluate the performance of my employees. The best tool I could use is uh, I could define certain KPIs for these employees, and then I could use these KPIs to judge their performance. Now, when I'm looking at long-term projects, when I'm trying to decide, when I'm trying to decide out of multiple projects in front of me, which one has to be chosen, at that time, certain investment appraisal techniques will come to my rescue. So, in AFM, we called it investment appraisal techniques, but here, what we are going to call them is we are going to call them long-term financial performance measures. Long-term financial performance measures. Basically, helping us to decide whether a particular project, which is basically going to span more than 1 year time horizon, how do we decide between these two projects, which one has to be chosen? Now, we'll get into the advantages and disadvantages part a little later. But when it comes to appraising long-term projects, basically, we have quite a few techniques that we have been using. First one is return on capital employed. What does return on capital employed tell me? Return on capital employed tells me how much return in percentage terms does a project generate on the initial investment. So, and how do you calculate ROCE? ROCE is basically profit before interest and tax divided by capital employed into 100. What is the rule? The decision rule here is that if ROCE is greater than the threshold, if ROCE is greater than the threshold, then accept the proposal. Now, the interesting part is that these thresholds are defined by the entity itself. There is no one size fits all approach. Different entities could have different approaches. Like, for example, my threshold would be that I should get a minimum profit of 15%. And if my ROCE is greater than 15%, then I will end up accepting the proposal. Like return on capital employed, I also have a measure called return on equity. What is return on equity? Return on equity tells me that on the overall funds that I have raised from the owners of the business, that is from the providers of equity, how much return is generated on the equity investment in the company? How much return in percentage terms is generated on the equity investment? Okay. How is ROE calculated? This is profit after tax divided by equity. Now, see, in your AFM paper, whenever you used to calculate return on equity, I think your numerator was profit after tax and preference dividend. Because, classification of shares into equity and preference and all of these things played a crucial role in decision making. Here, that level of detail, you need not necessarily expect in the question. Then you have the payback period method. What was the payback period method? Payback period method tells me within how much time is the initial investment made in the project recovered. Okay. So, within how much time is the initial investment made in the project recovered? I'm sure this information is fed into your Instagram every day where someone comes on an ad and tells you that, when you join the ACCA course, the first job that you get will help you to recover the initial investment made in ACCA within the first 6 months itself. So, how are these people trying to fool you? What they are trying to tell you is invest 5 lakh rupees in ACCA, that is tuition cost and examination fee and everything, and the first job that you will get will be worth 10 lakh rupees. So the initial investment made in ACCA will be recovered within a time span of 6 months. That is what payback period is all about. Now ideally, lower the payback, better is the project. But this payback period method suffers from certain disadvantages and limitations. What are these? Payback period method does not consider time value of money. First problem. Second problem, cash flows that happen after the payback period are often ignored. Now, for example, look at this project. Okay. One major disadvantage is that cash flows that happen after the payback are ignored. Okay. Let's assume that there is an initial investment of 1500 made in a particular project. Then you recover 300. Then you recover 600. T3, another 600. So initial investment 1500. All of that is recovered by the end of year 3. Okay. All of initial investment is recovered by end of year 3. So payback period is 3 years. But there might be cash flows that continue in the project after year 3, and you should be aware of these. In T4, you might have 400. In T5, you might have 200, then another 2, then another 100. And at the end of the project, there is a possibility that there is a huge terminal cash flow that you might have to incur. Now, what kind of a cash flow could this be? Say, for example, you are involved in setting up an oil extraction plant in the sea. And for some reason, the government has increased the cost of site restoration and cleanup. And this amount turns out to be 4000. Okay. Huge terminal cash flow. And if you observe, you start with an initial investment of 1500, you move on year, and by the end of year 7, if you continue with the project, you are in a way out of 3300 from your pocket, right? So you looked at the project initially and you came to a conclusion that my money is paid back to me within a span of 3 years. So this project has a less payback. Let me go ahead with this particular proposal, only to realize after continuing with the project much later that at the end of T7, there is a huge terminal cash flow, and this huge terminal cash flow makes the project completely unviable. But the payback period method completely ignores that. It ignores the cash flows that take place after year 3. इसके बाद के cash flows को you often end up ignoring. And that is the reason why the payback period method not is not considered as, a very reliable method when it comes to investment appraisal. There is a updated method called the discounted payback. Do you recollect what the discounted payback period method is?
Yes, sir.
So, see, there were two disadvantages with this method. Okay. The first disadvantage was ignores time value of money. And the second disadvantage was that cash flows that happen after the payback period are ignored. After this method received a lot of criticism, what people decided to do was they decided to somehow get rid of the first limitation that this method ignores the time value of money. So, discounted payback tells me within how much time initial investment made in the project is recovered after considering the present value of cash flows. ठीक है. Again, lower the payback period, better or more acceptable is the project. Look at this method. See, when you say, for example, you are using a discounting factor of 10%. So 1, 0.909, 0.826, 0.751, 0.683, 0.621, 0.564. ठीक है. These are your regular discounting factors. Now, how much are the discounted cash flows? Multiply. I don't know what is the discounting factor for the seventh year. 0.513. So what are these? These are my discounted cash flows. Now, what is my endeavor? My endeavor here is to find out that after considering time value of money and applying that to my cash flows, within how much time does the recovery of initial investment happen? For that, I'll have to calculate cumulative cash flows. Okay. What are cumulative cash flows? Add the cash flow of the current year to the total so far. See here, your payback was happening at the end of year 3. Payback was occurring at the end of year 3. Here, payback is occurring somewhere between year 4 and 5. Okay, this is where your payback is taking place. Now, discounted payback period method introduces an additional level of caution. Okay, because you have taken discounted cash flows, now you know that after considering the time value of money and bringing all the cash flows to the present level, when am I able to recover the initial investment made in the project? The recovery is happening somewhere between year 4 and year 5. Okay, so this is an improvement over payback period as it considers time value of money. Okay. And this method introduces additional caution. Why am I saying it introduces additional caution? See, it is delaying the payback for me, which means it will alert me in a certain sense that my payback now is not happening at the end of year 3. It is happening between year 4 and year 5. So I should be a little more careful while investing in this project because the payback is happening a little later. Applying the discounting factor is somewhere reducing the present value of cash flows and it is pushing the payback to a later date. But still, this does not solve the second disadvantage. What is second disadvantage? That this method basically ignores cash flows that take place after the payback period. Like this huge negative cash flow that took place after T7, somewhere this method does not take this into consideration. It is happy with the fact that payback happens between year 4 and year 5. And it simply ignores whatever events might occur after this date. So these basic, these base level methods were not able to primarily solve the problem of appraising long-term projects, which is why we then went ahead and came up with a method which was which basically tried to solve all these problems. This method was based on cash flows, not on profit. This method considered the time value of money. This method also looked at it also looked at all the cash flows, not just those cash flows which occur till the payback period. And This method also helped us to understand the first and the foremost objective of business, which was maximization of shareholders' wealth. How it helped you to achieve that? Let us see. This net present value method, NPV, is calculated as PV of cash inflows minus PV of outflows. So, cash flows occurring at different points in time will be given to you. Maybe they will give you some information about sales and cost and fixed cost and variable cost and all of that. Here, because it is APM, the focus might shift a little to analyzing relevant and non-relevant cash flows. We look at a question to understand how it works. So here, if NPV is greater than 0, let us understand what is the decision rule. The decision rule is, if NPV is greater than 0, then accept the proposal. If NPV is less than 0, then reject the proposal. And NPV tells me how much of an increase in shareholder wealth is achieved by undertaking this project. So this value PV of inflow minus PV of outflow is primarily telling you, okay, if I undertake this particular project, then what are some of the benefits that I will derive out of it, no doubt, but how much of, if the NPV is, say, for example, 1 lakh, that means it adds to the shareholder wealth by 1 lakh rupees. Now, NPV can be calculated using the spreadsheet function also. NPV can be calculated using like a detailed pro forma also. In your exam, if at all a question on NPV comes, then you should remember, just prepare the NPV pro forma, fill in the values, and you will get your answer. Okay. Now, this method, the advantages and disadvantages, something, they have been asking right from skill level. P level happens to be no different. Who knows, when you are appraising two projects and they see, you are trying to find which project has performed better, they might end up asking you uh, the advantages and disadvantages and then choosing a better indicator of performance. So it's it's good if we know the advantages and disadvantages. The good part is that there is a strong correlation with shareholder value. NPV directly tells me how much of an increase in shareholder value will be achieved. It considers time value of money. Risk can be allowed for by adjusting the cost of capital. If I increase the cost of capital, my present value will decrease, right? So if I want to incorporate the impact of risk, all I have to do is I have to use a higher rate of discounting, and that will help me to critically analyze the project even further. Okay, it considers all project cash flows, not just the cash flows which occur till the payback period. Cash flows are less subject to manipulation and subjective decisions than accounting profits. I mean, so much that we study in accounting is just an imaginary construct, right? Think of leases, think of deferred taxes. I mean, those are all con jobs. When, why do I call it a con job? Because think about IFRS 16. I am using an asset by paying a rental to someone. Okay, it is not legally registered in my name, but because I have this uncontrollable desire to apply the concept of substance over form, an asset which belongs to other person, I'm treating it like my own asset in books of accounts and calculating depreciation and whatnot. So accounting profits are a subject to accounting standards, and they can be subjected to quite a lot of manipulations, so to say, which is why cash flow based methods, cash flow is real. I know how much money is hitting my bank account, and it is superior to methods like IRR and all of that, because IRR is still a relative measure, plus that method has a lot of assumptions, so it is less reliable. For beginners, it is difficult to calculate and understand. In your generation ka language, this method is for legends. For beginners, methods like ROC and all of those are okay, because people find it very difficult to understand the concept of time value of money. It does not easily allow two projects of very different sizes to be compared. I mean, the NPV of a project is an indicator of how much it adds to shareholder wealth. But you should also understand that NPV has to be in relation to something. For example, let's look at this. Project A and project B. If I tell you that the NPV in project A is 8,000, NPV in project B is 9,000. Which project will you prefer, Sharwani?
B.
B. Why? Because it gives you a higher NPV. Now, allow me to introduce one more variable. I talk about the initial investment made in the project. Okay. In project A, there was an initial investment of 10,000. In project B, there was an initial investment of 20,000. Okay. Ab now, what now when I give you this information, suddenly your perspective changes, right? Project B has a larger capital outlay as compared to project A. So I cannot simply look at NPV to decide which project is a better decision for me. I will have to compare that with reference to the initial investment made in the project. So I do NPV upon initial investment. Now, what does this tell me? We call this profitability index, by the way. Okay. But profitability index tells me how much NPV is generated for every $1 invested in the project. So if you invest $1 in project A, you will get an NPV of 0.8. If you invest $1 in project B, you will get an NPV of 0.45. Now, if I ask you the same question, Sharwani, which project will you prefer? Your answer might change to I will prefer project A, right? So it does not easily allow two projects of different sizes to be compared. Till now, I was only talking about the initial investment. Let me introduce one more variable. Okay. Same data, ठीक है, but now the tenure of the project is 4 years and tenure of the project is 7 years. Tenure means for how long did the project run. Now tell me, how will you calculate and let's assume that the discounting factor is 10%. Assume that discounting factor is 10%. Now, comparing 8,000 and 9,000 does not make sense because these projects they are giving you NPV over different durations of time. So how will I calculate which project makes more sense to me? In this case, what I will do is I will calculate the annuity factor for 4 years. 1 minus 1 plus 10% raised to minus 4 upon 10% raised to minus 7 upon 10%. So this becomes 3.170. This becomes 4.868. Now I have the annuity factor. See, if I divide 8,000 by 4 and I divide 9,000 by 7, that's like, a beginner level rookie mistake. This 8,000 is present value over a span of 4 years. This 9,000 is present value over a span of 7 years. If I divide this by 4 and divide this by 7, it will be an extremely unfaithful comparison. So if I want to compare two projects that span different periods of time, then in that case, what I should do is I should divide this 8,000 by 3.170 and I should divide this 9,000 by 4.868. This number is called equivalent annual benefit. In annual terms, how much money am I generating? How much present value am I generating each year so that the net present value that I get is 8,000 or the net present value that I get is 9,000. Now, the calculation of equivalent annual benefit is not necessarily a part of APM syllabus, but you see, I started changing the variables one by one and my analysis started getting more and more complex. Here I used It was still an easy calculation because, profitability index is easy to understand. Equivalent annual benefit is not so easy to understand. By the way, this was there in skill level FMI, if you remember. Replacement decisions may there was equivalent annual cost and then there was equivalent annual benefit also. It's not in your APM syllabus directly, but you see the complexities that have started entering your discussion the moment variables started changing. So it does not easily allow comparison between projects of different sizes. Now imagine both variables change at the same time. Initial investment also is different, and the projects are for different lengths of time. Then in that case, NPV might not be the only tool that will help you to get answers. Plus, there are a lot of assumptions that we use in the NPV method. What kind of assumptions? All cash flows occur at the end of the year. Then sales increases by so and so percent. Discounting factor remains constant. In one of my CFA classes, we did discuss this part that when see, this is one of the biggest flawed assumptions in the NPV method or in appraising any investment for that matter, that the discounting factor remains the same every year. What is your discounting factor? Discounting factor is the weighted average cost of capital. What is cost of capital? Expectation of the providers of finance. Now, the expectation is not going to remain the same every year, right? If the expectation is changing every year, that means WACC is changing every year. If WACC is changing, how can we use the same rate for discounting? Does that not throw out this calculation into the garbage bin when you realize that the very premise on which you are doing your NPV calculation is wrong? You assume the same discounting rate every year, right? And that is a problem. And many firms use NPV for investment appraisal and then switch to profit-based measures to motivate managers. Ye to chalo, this is stupidity on behalf of the firm. Key, you start with a cash flow based measure, and then when managers feel that we'll never be able to achieve the target, then you shift to a profit based measure so as to extract some performance out of them, and that's not a winning combination in any way. So the NPV method is great, but these are some of the challenges associated with the NPV method. And as someone who is evaluating performance of a project, now you are not a finance manager, you are not making a decision of whether to invest in the project or not. You have multiple projects in front of you. How will you tackle that? Which project will you choose? How will you say that performance of this project is better than some other one? वहां पे you will need to have a knowledge of all of these factors. ठीक है? Now, let's uh, let's look at a concept called sensitivity analysis. I'll give you a background of what sensitivity analysis basically stands for. When I say I am sensitive, beach mein I had my tooth was broken. So if I drank something cold, I felt like a tingling sensation all through my body. That means I had become sensitive, right? Sensitivity is basically reactivity to something. Now, what are we reacting to, or why are we looking at sensitivity when it comes to appraisal of performance? Think about it. There is a project whose NPV is 40,000 positive. You are happy, you are rejoicing that it is a positive NPV project. Let me go ahead with this particular proposal. But you realize that how is this NPV of 40,000 derived? This NPV of 40,000 was derived when the selling price was 10 rupees per unit, variable cost was 4 rupees per unit, and you had arrived at a particular NPV. Now, what if one of these variables were to undergo a change? If one of these variables undergo a change, my NPV will automatically get affected. And what if the selling price goes down? I will reach a point where my NPV might go from positive to negative. And what is that fall in selling price beyond which the project becomes unacceptable? That is basically what sensitivity analysis tries to tell you. Before giving you a formal definition of sensitivity analysis, let me present some data in front of you. Okay. There is a project one. Okay. Particulars, initial investment. I'm not making it a very big project, don't worry. T1, T2, T3, T4. Now there is initial investment. How much? Say the initial investment is 1 lakh. Okay. Now, units produced. Let's say I'm producing the same number of units each year. Selling price per unit 30. Variable cost 12. What is contribution per unit? Sales minus variable cost 80. Okay. Now, what is my total contribution? This is all in cash, huh, by the way. Total contribution, cash contribution. I'm not talking about any notional cost or tax saving and all of that right now. 10,000 into 18, 1 lakh 80,000. Now, let's say that the tax rate is 25%. Okay. Tax at the rate of 25%, assuming tax is paid in the same year in which income is earned. So, this into 25%. What is my post-tax cash flow? 1 lakh 80 minus 45, 135. Are you with me so far? Now let's say that my discounting factor is at the rate of my cost of capital is 12%. Okay. So 1 upon 1 plus 12% raised to 0, 1, 2, 3 and 4. 2, 3 and 4. If you get stuck at any place, please tell me. Huh? What is the present value? Okay. Just one moment. Huh? What is my net present value? PV of inflow minus PV of outflow. 3 lakh 10,042. Should I accept the proposal? Yes. Now the question is, how much of a fall in selling price can I tolerate? Let's say selling price, there is a lot of pressure in the market, like there's a lot of pressure in the ACCA market right now because so many people are jumping in. Everyone has to lower the prices at which they are selling the course. Let's say selling price falls down to 27 because of market pressure. What impact will it have on NPV? ठीक है. Initial investment, contribution. Contribution will be 10,000 into 27 minus 12. What will be post-tax contribution? This into 75%. I already have my discounting factors in place. What is my present value? Has my NPV dropped? Yes, it has. But is the project still acceptable to me? Yes, the project still remains acceptable. It has gone down from 3,10,000 to 241,702, but it has still not become negative. So I can accept the project. I can tolerate this fall in NPV. The question is, how much of a fall in selling price can I tolerate before the project becomes unacceptable? That is sensitivity. Sensitivity means how much of a fall in selling price can I tolerate before the project becomes unacceptable. Now, when will a project become unacceptable? When its NPV falls below zero, I am okay as long as the NPV is above zero. I am okay even when it touches zero. But the moment it falls below zero is when I will have a problem. So, in this case, how is sensitivity calculated? I'll spare you the detail of formula derivation, but sensitivity margin is calculated as NPV divided by PV of post-tax cash flow under consideration. ठीक है, NPV divided by PV of post-tax cash flows under consideration. Now, in this case, what is my cash flow under consideration? Sale revenue, correct? Sales. Up. PV of post-tax cash flow under consideration. Now, what is my total sale year on year? ठीक है, year on year my total sale is 10,000 into 30 right now. ठीक है, now what this is my total sale cash inflow. Now if I have to calculate post-tax cash flow, how will I do it? Post-tax cash flow will be this into 1 minus 25%. Correct? Post-tax cash flow or post-tax anything is that item into 1 minus tax rate. Now, can I calculate the PV of my post-tax cash flows? Let's see if that is doable. ठीक है, my current NPV is 310042. What is the PV of post-tax cash flows under consideration? This much. So if I have to calculate sensitivity margin for sales, I will take NPV. How much is the original NPV? The original NPV is 310042. So I will take 310042 divided by total of these four. That is 683,404. 683,404. 310042 divided by sum of these. I have gotten 45.37 as my sensitivity margin, which means what does this mean? What does sensitivity margin of 45.37% mean? It means that if sales price falls by more than 45.37%, then the project becomes unacceptable as NPV will be lesser than zero. This is your basic idea behind sensitivity. Sensitivity might have been like a 2-mark adjustment sometimes in AFM, or in order to improve the quality of your answers, sometimes you could have referred to sensitivity in your answers. But in APM, when you are trying to appraise which project is better, which one should you invest in, which project has met the expectation of the management and which is not, sensitivity calculation is likely to play a very important role, which is why understanding sensitivity is all the more important when you are preparing for APM. Are you with me, all of you?
Yes, sir.
Now, Let's look at one more method of appraising investments, which is your internal rate of return or IRR. Now, internal rate of return is the return generated by a project, assuming that all cash flows from the project are reinvested in the project at the same IRR. ठीक है? At the same rate, that is IRR. Now, IRR is also the rate at which the project breaks even in present value terms. So when you are calculating IRR is that rate which reduces the NPV to zero. ठीक है? IRR is that rate which reduces NPV to zero. ठीक है? Now, whenever you are looking at the IRR calculation, please understand that A, it is a rate at which the project breaks even in present value of cash flow terms. ये जो method है, what they are saying is whatever returns a project is generating for you, like I have invested money in, say for example, I start my own coaching classes. Okay. Now when I start my own coaching classes, I, invest money and I collect fees from students and my business has started running. Now this method says that IRR is the return generated by the project. So far it's okay. But return generated by the project, assuming that all cash flows from the project are reinvested in the project. Now that's practically a little difficult to achieve. Now, when I do my own business, I generate some good returns. Don't you think I would want to use some part of that return to take a trip to Japan? Or to buy a watch for myself, or indulge in something. But this method is specifically telling you that cash flows from the project will be reinvested in the project itself. You cannot withdraw a single rupee out of the business. The entire amount will be reinvested in the project. And the second part of the assumption is that it will generate the same rate as you envisaged at the beginning of the project. Both these assumptions are highly flawed in my opinion. Very rare for you to have all the cash flows getting reinvested in the same project. Even more rare that these reinvested cash flows will generate the same return as you envisaged at the beginning of the project. So IRR, see, the good part about IRR is that, it gives you a comparative evaluation of projects, and you can look at the two projects and tell ki if the IRR is higher, then that project is better. The decision rule here is decision rule IRR greater than cost of capital, accept the proposal. IRR less than cost of capital, reject the proposal. And calculation of IRR in the exam is, in APM specifically, is an easy job. Okay, so how is IRR calculated? Pay attention. We are going to use the spreadsheet function, not going for the in-depth calculation that we used to do in FM. ठीक है? T0, T1, T2, T3 and T4. Write down all the cash flows from the project. Minus 1 lakh initial investment, 40,000, 55,000, 60,000, 72,000. Okay. Now these are the cash flows. You want to calculate IRR. Your job is simple. Write down equal to in the spreadsheet. Write IRR. Press tab. Select the range of cash flows. Close the bracket. Press enter. 38% is the IRR of this project. Very simple. There is the long interpolation method also, but I don't think when such an easy method is available to you, you would even want to look at the other method. IRR less preferred as compared to NPV. IRR less preferred as compared to NPV method. IRR, ek to it doesn't tell you how much of an increase in shareholder wealth is happening because of undertaking this particular project. Plus, it is based on so many assumptions that it might become a little difficult to, incorporate this in decision making. NPV is a better method to determine which project should be chosen. Again, IRR had two problems. One was the assumption that all the cash flows are reinvested in the project. Second was the assumption that these reinvested cash flows generate the same level of return that you envisaged at the beginning. Now, when this problem was put across, the one conclusion that we came to was we cannot get rid of both the assumptions. We can get rid of the assumption which is more unrealistic. The second assumption was more unrealistic, that all the cash flows are reinvested in the project and they generate the same level of return as the IRR. So what we did is we modified the IRR. Okay. Modified internal rate of return. We call it MIRR. Okay. MIRR gets rid of the assumption in IRR that cash flows reinvested in the project yield the same return as IRR. Here, the assumption is that cash flows reinvested in the project give you the same return as company's cost of capital. See, what is cost of capital? Cost of capital is the total cost of raising funds from different sources of finance, weighted average वगैरह करके. ठीक है. So cost of capital represents the cost or the amount that I have to incur in order to raise money from different sources. I take the weighted average of that number. And any prudent businessman, even a beginner, will tell you that if the cost of raising finance is 12%, the project that I am investing my money in, it should yield at least a return of 12%. If it is not giving me that much return, then I should not be in the business, or I should not take up that project in the first place. So what is our assumption? That all the cash flows that are reinvested in the project will at least give us a return equal to the cost of capital, which in my opinion is a fair assumption. Because if the project is giving you lesser returns, then you should say tata bye bye to the project, because it doesn't make sense. And we are going with the most reasonable assumption कि कम से कम the return that is generated for us is minimum equal to the cost of capital of that particular business. ठीक है. So how is MIRR calculated? MIRR is PVF upon PVI, or PVR, not PVF. PVR upon PVI raised to 1 by n into 1 plus RE minus 1. Or you could use the spreadsheet function. That's also an option. I'll tell you what each of these stand for, but still, where PVR is PV of cash flows from return phase. Return phase means since the time the project has started generating positive cash flows, uska aapko present value nikalna hai. What is PVI? Present value of investment phase. What is investment phase? Investment phase is basically the initial investment. If there are certain situations, where the first 2 years you keep on investing money in the project and it starts generating returns from year 3 onwards. So in that case, year 1 and year 2 will be investment phase. Year 3 onwards will be the return phase. What is N? N is the period or tenure of the project. Tenure of the project. Okay. Then RE. What is RE? आयुष, याद है आपको व्हाट इज आरई?
सर,
हम्म। क्या
नो
है
आइडिया,
आरई?
भूल गया मैं।
वेरी नाइस। आरई इज फर्म्स कॉस्ट ऑफ कैपिटल। फर्म्स कॉस्ट ऑफ कैपिटल। ठीक है। इफ you love to make your life difficult, calculate using this formula. If you don't, we have easier ways to tackle this situation. ठीक है। Write equal to MIRR. अच्छा, for this you need to know the cost of capital. Okay. Cost of capital of the project is, say, 12%. I could take some, like better numbers in this case. But चलो इसी के साथ करते हैं. Let the initial investment be, for example, let the initial investment be 15,000, and in years 1, 2, 3, 4, 5 you are getting 1,500, then 2,750, then sorry 4,000, then 5,700, and in say T5 I am getting 7,500. Firm's cost of capital is 12%. What is my MIRR? Right, equal to MIRR, press tab. Select the range of cash flows. Financing rate, cost of capital is 12%. All the cash flows are assumed to be reinvested at the cost of capital. So, comma karo, reinvestment rate is also 12%. 10.87 is your MIRR. यहाँ पे 38% was your IRR. Here 10.87 is your MIRR. How do we calculate MIRR? Tab. Select the cash flows, comma. Finance rate. Finance rate is the cost of capital, which is 12%. And cash flows are assumed to be reinvested at the same rate, 12%. You get 10.87 as your answer. ठीक है? This represents the actual return generated by the project. If MIRR is greater than cost of capital, accept. If MIRR is less than cost of capital, then reject the proposal. ठीक है? Are you with me? MIRR represents the actual return generated by a project. Up, there are certain past exam questions in which IRR, MIRR, NPV, payback period, not in the same question, but in different questions, they have been tested. I did not want you to get caught by surprise, which is why I thought let's have a small session on this so that you know कि किस level of detail में आपको जाना है. ठीक है? Now give me one moment, I'll be back and then we'll continue. Just one moment.